Hey guys, this is the market update. There are two things you need to know about Bitcoin and crypto right now, macro and micro, which I'll go through in this video. We're going to look at Bitcoin, ETH, and then the two scenarios that are going to be playing out and the uptrends that we're in right now. Are these going to hold? So coming to Bitcoin first, look, we're in an uptrend right now. Very, very clear to see. We're breaking through all of these resistance prices, and the next major resistance, the major resistance is 31K. We're just grinding up through this now. Now, the reason we're grinding through this is because of the ETF applications. And so this is obviously something that can explode the price if they happen. But of course, if they get delayed, then this is just going to be a kind of popping of that bubble. Around the 12th and 13th of August is when the first decisions are going to be made. ARK actually have their ETF, which they've amended to make it the same as BlackRock's. That's coming out, I think, on the 13th. BlackRock also have their first decision, I think, on the 12th of August, something like that. And so if the SEC is going to approve all of them at once, then that is going to explode the market. If the SEC still says, no, you know what, we're going to just delay these, then it's going to be another 90 days and so on. And actually, it's the start of next year when the final decision is to be made. We still don't know what the SEC is going to do, but we have to remain cautious. We are at massive resistance right now on Bitcoin, as you can see right here. So we're at 30.31. Now, if we don't get the ETF applications, what do you think is going to happen? We can't break through into new areas. It's just impossible. But as you can see, this uptrend is forming. And so anything down to around 25, 26 is still a higher low within that uptrend. Let's move over to ETH again, and you can see an uptrend from the lows. This is a very clear uptrend right now. What is going to force us down? Well, it's a rejection of the ETFs or pushing them out. But again, what we're looking for with this uptrend is just grinding higher all of the time. Another higher low would actually bring us back down to this support level at 1700. We may not get there, but if the ETFs get pushed back, then that might happen. But this is a clear uptrend for ETH and for Bitcoin. And a lot of alts are actually coming off their secondary lows as well. So if you go and look at Solana, Cardano, you're seeing double bottoms or higher lows there. So the money is starting to speculate again, but it's the ETFs that are going to push us within the next 6 weeks to 2 months. And so that's really what we need to look out for. If you are a trader, deposit bonus on Bybit, check the link in the description, up to $30,000 deposit bonus. Check the details via the link below. The macro cycle has completely changed. So the next thing to look for, apart from the ETFs, is one thing only, and that's unemployment. All of this data proves that the cycles have changed, but the one thing that will lead the Fed is unemployment. So what we can see here, this is from Raoul Pal. This is US CPI year over year in white. The blue is inflation from different economic cycles. And you can see that we're very similarly following this. I'm a believer that we're not going to get structural inflation in the CPI like we did in the 70s for many different reasons. The main one being demographics. Supply chains are different these days. I'm a believer of that. However, it's really wages that are the big problem, which is why the unemployment rate is the thing to focus on. CPI and wages aren't really the same thing to look at, which is why the Fed looks at core inflation rather than CPI, because CPI is very noisy. And as you can see here, over time, it will come down. What we're also seeing here is the S&P 500 index in white as of right now versus the similar trajectory of it in previous historical episodes and market cycles. Very, very similar. Of course, past performance isn't an indicator of future performance, but as we can see, maybe the recession was priced in and maybe we're coming out of that now in terms of markets, which, as we know, asset prices look forward and price in the future and not what's happening now over the next 3-6 months. The financial system has already cracked. You saw that in the UK with the gilt market. The UK government stepped in. The banking system cracked in the States. The government stepped in with the BTFP. Liquidity is actually increasing over time, or at least going in waves of increasing. That's different to what we saw during the bear market. We can see some data here. This is the Global Liquidity Index from Raoul Pal as well, how it tracks the NASDAQ. He says that it has an R-squared of 97%, which is obviously an extremely high correlation here. So global liquidity does force asset prices either higher or lower if it is increased or decreases. As you can see, we got that decrease, but liquidity is actually rising again. Not just in the States and Europe and the UK, but in China as well, who are smashing liquidity into their markets to stimulate growth. And so those things will happen if the economy slowed down further in the States. Now, it's been fairly robust, but I'll show you some data here that shows how the economy is falling away in different parts, in different stages. So what we really need to see is more liquidity being pumped in and animal spirits being let go. However, the Fed won't let us do that until unemployment ticks up in the way that they want, because they have two remits: inflation and employment. Unemployment is still way too low for them to change any of their rhetoric. But once that ticks up, we'll have liquidity increasing and the rhetoric changed, which is bullish for markets in my opinion. As we can see here, a huge drawdown in liquidity over the bear market. However, it's changed, right? It's changed now. You're not getting that huge drawdown again. You're getting liquidity just seeping into the market. This is from the BTFP here. So as you can see, a drawdown again here, but this is stress on banks. And so the more stress you have, the more they react and more problems occur, and then government step in again. So we're seeing that as the drawdown in 2021, but in a different regime now, right? It's not as harsh. And so if it's not as harsh, then you're not going to get the big drawdowns we saw during those times. If this does fall off a bit further and you get more stress, governments and the Fed and other central banks have already stepped in. They've already stepped in to increase liquidity, and they will continue to do so. They do it every single time, and so we should assume that as a market participant, which is why risk assets are pricing in this flip and the turn of what's happened in liquidity. All of the data coming out is showing a slow and sluggish economy. Doesn't really matter for Bitcoin though, because what that's really pricing in is government intervention, right? So as you can see here, it's not often 100% of the ISM manufacturing components register a reading below 50. 50 is growth, 50 and above is growth. Below 50, you're not looking at growth here. 100% of them are in contractionary territory. As we're also seeing here that the recent PMI figures that came out are now at 46, which is not seen since the COVID recession and the GFC recession. Huge, massive contraction in the real economy is what we're seeing right here. The last thing to go is unemployment. Once unemployment starts ticking up, and we see that, the Fed's rhetoric will change, because they tell us that they have two remits, inflation and unemployment, and they will just put rhetoric out to whichever one they want to control at that time. So inflation starts coming down, unemployment starts going up, the rhetoric changes. If you're invested in crypto as well, we must remember that crypto is not the stock market. It isn't an equity. These are very different. So Bitcoin and ETH are going to be pricing in things differently to that. They are furthest out on the risk curve. They are the longest duration. And so they are going to be pricing in the flip and the turn the fastest and the heaviest. So Bitcoin up 85% this year, Ethereum a little bit less, but they will be pricing this stuff in before a lot of the rest of the market. And actually we can see that here as well. The rest of the stock market is not doing well right now. And so if you're invested in those companies, as you can see, you're basically making no returns whatsoever. You've just got the AI trade and the tech trade, which is also long duration, which is also pricing in the flip, furthest and fastest. But also, of course, you have the AI trade there, which is specifically with those stocks. But Bitcoin, ETH, crypto is a growth industry as well, and it's pricing in the macro flip for sure, as Bitcoin is a macro asset. If all of the ETF applications are pushed back in August and none of them are accepted or any more details given, then expect a little bit of a deflation from the price, because some of this price is, of course, the ETF hype. But I think it's a matter of when and not if at this point. And so any dips, I'll be there to buy them. Buying dips in this market, because this is an uptrend. We have changed now. It's not a bear market anymore, in my opinion, especially when we break through 30K. If you are a trader, Bybit deposit bonus up to 30K. Check the details in the description. Join the Crypto Investor course as well, and over 300 videos and private Discord groups. You can come and ask me any questions you want in there. Link below as well. I'm James, Money ZG. Cheers for watching, and I'll see you in the next one.